June 30th, 2026. Freeze. Don't scroll. I'm dead serious. Open your silver chart right now. In a second tab, open any major dealer site or call your local shop. Compare the spot number to the real checkout price and tell me why it feels like the screen is living on a different planet. Today, spot is doing Olympic-level yoga, stretching reality until it snaps back and hits retail in the face. Here's the pain. Most people treat the spot price like it's the gospel truth. They make decisions off it, and when the gap between paper and physical widens, the public gets whipsawed by emotions, while the big desks get cheap paper exposure and better positioning. I'm going to show you the one metric that matters more than spot, because it's the lie detector for this market. Once you see it, you'll understand why COMEX stressed physical is not a conspiracy meme. It's a repeatable mechanism. First, a live bulletin snapshot. As of midday Eastern Time, the silver spot is $28.70 an ounce, down 1.2% on the day. Key levels are around support at $28 and resistance at $30. You can verify that instantly on Kitco, TradingView, or the active COMEX quote. The headlines will tell you this is normal. A little macro noise, a little dollar move, a little yield move. Everyone pretends the market is neatly priced, but the physical world tells a different story. In stock becomes pre-order, delivery windows stretch, premiums stay stubborn even when the screen price dips, and buyback bids start acting like they don't fully believe the headline price. Today's catalyst backdrop is the looming jobs report. Yes, one sentence from the Fed or one data print can shove yields and the dollar around, and silver trades in that crosswind. But don't let the macro headline hypnotize you. Hold three things in your head: the spot print, the key levels, and the catalyst. Then we go straight to proof, because before you trust that number, you need to know what spot actually is. Spot is not the price you can actually buy silver for at checkout. Spot is a paper reference, a screen price formed largely in futures and wholesale benchmark ecosystems, built for trading velocity and liquidity, not for delivering you a tube of coins tomorrow. When you buy physical, you pay for reality, the metal plus fabrication, shipping, insurance, dealer risk, and during stress, scarcity pricing for immediate availability. And physical isn't one thing. Retail products like 1-ounce coins live in a different supply lane than 1,000-ounce bars, and when retail demand spikes, the retail lane jams fast. Also, language is a trap. Available can mean we'll get it later, while in stock means it ships now. In a tight market, that difference is everything. So no, your dealer isn't automatically overcharging. Often you're just watching two different markets with two different constraints. Now killer metric time, because opinions are cheap and this is measurable. The premium over spot spread, this is the number that exposes stress even when the chart looks sleepy. If spot is $28.70 in the same day, typical 1-ounce physical products are consistently priced about 15% above spot, roughly $4.30 per ounce. Across multiple dealers, that is not random. That is the market pricing physical tightness, fabrication capacity limits, and delivery risk. Don't take my vibe for it, take screenshots. Cross-check major dealer listings, JM Bullion, SD Bullion, APMEX, check your local shop, quote, and track it day over day. The trend is the punchline. Yesterday the spread was 13%, today it's 15%. If the spread is widening while spot chops sideways, the physical market is quietly voting with its wallet while the paper market performs for the cameras. For more confidence, add supporting evidence. Mint notices about delays, out-of-stock flags, and changing buyback bids are the real-time breadcrumbs. And here's the FOMO, but the ethical kind. If the spread keeps climbing, the first things that usually break are availability and delivery times. Then the buyback market reprices, and only after that does the chart catch up. So the obvious skeptical question is exactly what smart viewers ask. If physical is tight and premiums are high, why doesn't arbitrage instantly fix it and close the gap? Before we answer that, you need the villain, not a cartoon villain, but the structural villain, the paper-first system. Big banks and large trading desks operate where liquidity is deepest and fastest, futures and paper exposure, because that's where scale lives. Media then frames the paper print as the price, because it updates every second and makes neat headlines. In plain English, paper supply can expand instantly through contracts and leverage. Physical supply cannot. It depends on mining, refining, and shipping. In thin liquidity windows, concentrated futures selling can push prices down fast, trip stop losses, and suddenly the screen prints a story. Silver is weak. The public sees red candles, the media repeats the narrative, and weak hands sell at the worst time, while the physical market is draining quietly in the background with premiums that refuse to cooperate. Retail can't print ounces, paper can print exposure. That's the trap. Now watch the escalation ladder, because urgency is about time, not feelings. Yesterday, the market mood was shaped by a dip in ETF holdings, which gave people permission to relax and treat silver like a boring chart again. Today, the premium overspot lie detector didn't relax, it widened. This means the pressure underneath didn't go away just because a headline moved on. If you want hard plumbing signals to pair with that, look at COMEX registered inventory, around 40 million ounces from the official CME warehouse reports. Look at SLV and PSLV holdings, around 900 million ounces combined from the fund's published data. And where accessible, monitor lease rates currently around 1% as a stress gauge for financing tightness. You don't need every indicator to scream at once. You need a consistent story of physical tightness plus time-based catalysts. The next pressure point is the calendar. Options expiry next Tuesday, when positioning and liquidity games can intensify. 2 tripwires to watch like a hawk. 1, a sudden drop in deliverable inventories, and 2, another step up in retail premiums, even if spot stalls or dips. If either snaps, volatility can jump fast because the paper market moves in seconds and the physical market reprices in chunks. So what are silver price predictions today that aren't fantasy? 3 scenarios tied to mechanisms. Scenario A, base case, if the dollar and yields stabilize, silver chops in a range around $28 to $30 with lots of noise. Scenario B, bull break. If premiums stay elevated, ETF flows turn positive, and risk-off sentiment hits, silver can reclaim and hold above $30 and build momentum quickly. Scenario C, flush then rip. A macro shock could slam futures and dump the price toward $28, but if physical premiums stay sticky during that flush, it often sets up the rebound because it signals the sell-off was paper liquidity, not real-world abundance. Remember this line, paper can move fast downward. Physical tightness moves slower, but it's decisive when it persists. If you remember only one level and one metric, remember $30 and the premium overspot spread. Now let's make it personal because what this means depends on what you actually hold. This is education, not financial advice. If you're a physical holder, your edge is stability. Track your local availability, premiums, and buyback bids. A strong buyback price tells you where real demand sits. If you're an ETF holder, you're tied to the paper ecosystem. Watch flows and holdings updates. If you're a futures trader, your biggest enemy is leverage and margin timing. Watch expiry calendars and respect that stop cascades are a feature of this structure, not a bug. If you're a beginner, don't start with panic. Start with plumbing. Learn spot versus physical and why premiums exist. Now, that skeptic's question, why doesn't arbitrage close the gap? Because arbitrage isn't free, instant, or always convertible. Futures pricing often references large bar lanes. Retail demand is for fabricated products. Fabrication capacity, shipping, and financing costs eat the easy profit. In stress, listed inventory is not the same as deliverable inventory. The highway might be wide for paper liquidity, but the exit ramp to actual physical delivery is narrow and sometimes jammed. The gap only closes when real ounces move through the bottleneck, not when contracts change hands. Bottom line, June 30th, 2026. The spot is 28.70. The lie detector is the premium over spot spread at 15%. The 2 tripwires are deliverable inventory shifts and premium jumps. Your 3 scenarios are a range chop, a break above $30, or a flush then rip toward 28. If premiums keep rising while spot stalls, that's smoke. And smoke is what you watch before the fire shows up on the chart. If this helped, like and subscribe to MoneyMind Hub Pro and comment on your local premium and availability. Crowdsourced data often tells the truth faster than a headline. In the next update, I'll break down the 3 prints that often front-run a silver move. Inventory, lease rates, and ETF flows. Don't watch the headline, watch the spread. Disclaimer, this content is for educational purposes only and reflects personal opinions. It is not financial or investment advice. Markets carry risk, so do your own research and consult a qualified professional before making any decision.